Do you want to start trading Forex but still feel confused when you hear some terms like pips, spreads, trading sessions, or lot sizes? In this video, I will break down these terms to its simplest form. Even if you are a complete beginner or you don't know anything about Forex trading, by the end of the video, you will understand these basic terms and know how to use them to your advantage in Forex market. Welcome back to my channel. If you're interested in making money online or understanding how Forex market really works, then you are in the right place. So let's get down to business. So the first thing we are going to discuss is currency pairs. In Forex trading, you don't buy a single currency. It is always in pairs. So we have three main types of pairs in Forex. One is major pairs, second one is minor pairs, and the third one is exotic pairs. In a small time, I will show you in live chat these pairs and the reasons why they are divided in this form. So let's go.
I'm going to use these few pairs to explain what I mean by major pairs, minor pairs, and exotic pairs. So let's start with first one, major pairs. Major pairs are all the pairs that contains USD, that is US dollars. For example, Euro USD, GBP USD, USD Japanese yen. First, the reason why they are called major pairs is that first one, they have US dollar. Second one, they have tight spreads. Third one, this particular market moves very fast. You understand? And they are easily influenced by news or any global events. Then second one, which is minor pairs. Minor pairs are just a kind of cross pairing of other currency pairs. For example, Euro GBP, Euro JPY. These are minor pairs, and they are called minor pairs because they don't have the same speed, like they don't have the same volatility like the major ones that has USD in it. They are influenced by news, okay, but not as much as US dollar. And the last one, which is exotic pairs, like this one, Euro Lira. This is Turkish currency, okay. They are called exotic because they move very fast. They move very fast, okay. But the best pair for beginners is the major pairs, which is mostly Euro USD, GBP USD, USD Japanese yen, and other currency pairs that are paired with US dollar, because they have a high volatility and the market always moves fast for you to make money, and it is easy to analyze the market.
The second term is trading sessions. Forex market is open for 24 hours, and this 24 hours is divided into three major sessions. The first one is Asia session, the second one is London session, and the third one is New York session. These three sessions are very important in Forex trading, and they have different reactions. So your ability to identify and know how to trade these sessions will help you in a long way in Forex trading to make money and to avoid unnecessary losing of money. So in a few minutes, I will show you how to identify these sessions in real chart and how to trade them.
If you look closely, you can see that these charts are divided by these dotted lines. These dotted lines divide this chart into days, okay. For example, this is Tuesday, this is Wednesday, this is Thursday, this is Friday, right? So, but as I already told you, market runs for 24 hours. So we are going to use this particular day, being Thursday, to discuss market sessions. First, let me expand this particular day. All right. So starting from here to here. So we are going to share this particular day into these three major trading sessions: the Asia session, the London session, and the New York session. I'm going to use horizontal line to indicate this. Asia session starts at 0000 UTC. Okay, and the market closes at 9 o'clock UTC. Then London session starts at 7 o'clock UTC and closes at 16 o'clock UTC. Okay, this is 16 o'clock, 16:30, 16 o'clock UTC. Then the New York session starts at 12 UTC and closes at 21 o'clock. Alright, so I'm going to change the colors of this line, these horizontal lines, to show you the difference. Let's change the color of a New York session to black. Alright, New York session. Then let's change the color of a London session to blue. Color of London session to blue. Okay, so these are the trading sessions that runs for 24 hours of the day. Market starting at Asia session and closing at 9 o'clock. Then New York session starting at 7 o'clock and closing at 16 o'clock. And New York session starting at 12 o'clock and closing at 21 o'clock. So if you look at these particular sessions, let me expand it a bit more to show you something. You will notice that there are lapses. Okay, there are lapses where these trading sessions had lapses, and I'm going to indicate these lapses with some triangular or rectangular bars. This lap here, there is a lap between this and this. Okay, this particular lap. So there is another lapse between this and this. So this first overlap between London session and Asia session is called Tokyo overlaps, and this overlap between London session and New York session is called London New York overlaps. So these particular points of overlap, I want to show you something about it. This is where the market is always very volatile. The market moves very fast in this particular point because there are two sessions trading at the same time. All right, so if you look at this place, more especially between the overlaps between London time and New York time, in this particular point the market is always volatile. Look at this movement. The whole of this movement happened when the New York session opened and when the London session closed. So as a forex trader, these are the key times where, or the key parts of the session that you need to be very much interested in and also very careful to make money or to be careful not to lose money. So that is all about trading session. We will discuss more about trading session in our next lesson, because this is just an introduction to help you understand what is trading sessions and how it looks like in real chart.
Next term is pips. What is a pip? A pip simply means the smallest price movement in currency pairs. So in forex trading, movements of currencies are always measured in pips, and understanding how to use and how to calculate these pips will help you very much when you start trading in forex market, because setting your stop loss and setting your take profit all depends on your understanding of the meaning of pips and how to calculate them. So your ability to understand what it means is very crucial, And in this particular video, I'm going to show you what it means and how to calculate them.
This is a breakdown of how to calculate your pips. For most pairs, 1 pip is equivalent to 0.0001. So most pairs are in 4 digits. Okay, but for JPY pairs, they are always in 2 digits, 0.01. In a short time, I will show you how to calculate your pips. Here is a general formula of how to calculate pips. Very easy and simple. For most pairs, pips is equal to price difference multiplied by 10,000. And for JPY pairs, pips is equal to price difference multiplied by 100. Let's use some pairs as an example to explain what we mean by this. Let's use Euro USD for example. Let's say price moved from 1.100 to 1.1050. Okay, to calculate the pips, we need to find out the price difference between the movement of price. We subtract 1.1000 from 1.1050 to give us 0.0050. This is the price difference. So to get our pip, we just use our formula. Pip equals to the price difference multiplied by 10,000, and this will give us our pips to be 50 pips. Another example is GBP USD. Let's say price moved from 1.2500 to 1.2525. We just need to find out the price difference in the price movement by just subtracting the smallest one from the biggest one. When we do the subtraction, it will give us 0.0025. This is a 4-digit pair, a major pair. So because of that, we multiply the price difference by 10,000 and it will give us 25 pips. But let's look at an example of JPY, Japanese yen. JPY has 2 decimal places. For example, let's say price moved 110.00 to 110.50. Okay, when we find the price difference by subtracting 110.00 from 110.50, it gives us 0.50. To get our pip, we simply multiply the price difference by 100 and it gives us 5 pips. It simply means that the price has only moved 50 pips. Okay, so this is exactly how to calculate your pips. And being able to calculate the number of pips that the market moves. Let's say for example you want to set your stop loss and take profit. This will help you to calculate the amount of money that you are ready to lose in the market and the amount of money that you will gain if the market goes in your favor. That's why calculation of pips is very important in Forex trading.
Then, another important term in Forex trading is spread. What does spread mean? Spread simply means the difference between the bid price and the ask price. The bid price is simply the price that you are ready to sell, and the ask price is the price that you are ready to buy at. In Forex trading, when you enter a trade, your trade always starts in negative. You understand? Negative means that once you enter a trade, you will be in a small loss. This small loss that you will be in is usually the spread. So when you trade different currencies, knowing spread is very important, because if you trade a currency that has a high spread, there is high probability that you will not make much profit. Even if the market moves in your favor, you will not make much profit, because this spread, the price of this spread, will be calculated and deducted in your profit, because this is the amount that you pay the broker that you are trading with his platform. So it is always better to trade currency pairs with smaller spread, and also to trade with brokers that do not give high spreads in their currencies. So right now I will show you how to calculate spread, and for you to understand the concept and know when the spread is very high in the market and not to enter such market, and know when the spread is tight and to make profit from it.
An example of how to calculate spread. So I told you that the bid price is the price that you are ready to sell, and the ask price is the price that you are ready to buy. So the difference between these two prices will give you your spread. So when you subtract the bid price from the ask price, it will give you 0.001. This is for 4-digit currencies. Okay, and when you convert it to pips using the formula that I just told you in this video, you get 2 pips, which means when you enter this particular trade, you are already in 2 pips loss. So that's why it is very important to know how to calculate your pips. When you see a market that has a very big difference between the bid price and ask price, it will be very difficult for you to make profit from such market. So you need to be careful. There are some sessions that the spread is always very big, and you need to avoid this kind of sessions. All these are some of the things that we are going to learn as we continue in this channel.
So with this, I believe that you have had a basic understanding of some terms in forex trading. So if you find this video helpful to reach other people and to grow our channel, we would like you to like, subscribe and share this video so that it will reach other forex traders or other people who are just beginners in forex trading and still find it difficult to differentiate these terms and still make mistake of calculating pips and spread and losing money in forex market. Stay tuned for the next video and see you.